We've been risk on for this entire year,
Okay,
right?
good
We
for you.
thought
That
that
worked.
equities were going to be able to power through a lot of geopolitical risk. We added to equities back in April of this year. So, we've had the benefit of the wind at our back. I do think that the Fed's likely to cut. I think that you've got the labor market. Looks like it could probably use some relief. I think consumers could use some relief as well. And I think there's enough in the pipeline from the data that we have that says that the Fed could cut. It may be a hawkish cut where they say, we're going to cut and this may be it for a while, or it may be one more of a dovish cut where they say, we're going to cut and we're going to be data dependent.
Okay.
I think that's what the market's going to react to. But remember, in 2026, you're only looking for maybe 3 cuts. So
Right.
if you get another 1 or 2, the market taking out 1 isn't necessarily going to cause a lot of damage.
Paul, the phrase data dependent was a drinking game for 2025. What should the phrase be for next year?
It's going to be who the next Fed chairman is. That's going to be the big flashpoint.
So how do you handicap that? Because I guess there's some parlor games out there about who it's going to be. Mr. Hassett, Mr. Besson, I don't know.
Right.
Do you guys care about it that much?
Well,
or?
of course we care about
Okay.
it, right? The Federal Reserve is the central bank of the world.
Yep.
It's a big one for us. We don't necessarily position our portfolios on who the next Fed chairman is going to be. We know that the Fed chairman, whenever they come in, they're always tested by the markets. We've seen this time and time again over the past 8 Fed chairmen that have been in place since the 1940s.
Mm-hmm.
It's either because they say something that the market misinterprets. No one knows exactly where their policy is. It's, they're going to be able to corral the committee. So we know that there'll be volatility around it. But I think the earnings support for 2026 is likely to be strong enough that it would probably present a buying opportunity.
Barbara Reinhard with us with Voya across this nation. Good morning the way you listen to us. Good morning, 92.9 FM in Boston. Good morning, and Hartford, Connecticut as well at Trinity College. I look at this, folks, and I want to give you a vignette because what Ms. Reinhard just said is really important. I'm in a room a couple days ago with Jacob Frenkel, the Bank of Israel, Mr. Shirakawa, the Bank of Japan, Portgay of Argentina. In the audience was Axel Weber of the Bundesbank, sitting next to John Lipsky, Definitive at Salomon Brothers and the IMF. And Barbara Reinhard, when Portgay of Argentina talked about the seriousness of this Fed shift, you could hear a pin drop in the room. I want you to explain why this is underestimated by the media. They're treating it like a parlor game. It's really serious. Discuss.
Of course, look, what the U.S. Federal Reserve does affects the rest of the world, and the transmission mechanism is really through the Treasury market, which is the benchmark of all risk-based assets throughout the entire world. And importantly, it also will have an effect on the U.S. dollar, right? A lot of weakness in the U.S. dollar this year has helped propel international equity markets. It means that places like the euro have had a lot of strength. That tends to be somewhat difficult for their companies to be able to, digest that increase in their currency. Makes the exporters under a lot more pressure. But the central bank for the U.S. is the central banker to the world. And I think you can't underestimate that. It's more than a parlor game. You have to watch it closely. But I think it's one of several things that we're watching over the course of 26.
You mentioned earnings, Barbara. We've had, really good earnings in the third quarter, good earnings in the second quarter.
Yeah.
Is the earnings outlook enough to support this market? Because it's not cheap, this market.
No, this market, unfortunately, is not cheap. But even if you don't get any multiple expansion over the course of 2026, you're likely to have, and this is if estimates get marked down, you're going to have 10% earnings growth, right? Bull markets don't die when you have earnings growth this strong. Earnings peak out generally about 2 years before a bear market starts, and bear markets get slaughtered by the Fed. I have the Fed still cutting interest rates. So while I realize that valuations are at nosebleeds, I don't think you get much in terms of multiple expansion, maybe even get a little bit of contraction next year. But I would say that the earnings are going to support the overall equity market.
You and Gina Martin Adams are on the same page. Gina Martin Adams folks at HB Wealth Management. And the heart of the matter is those earnings and even the revenue oomph up top comes from an ability to sustain margins. I don't hear anybody talking about margin erosion.
Yeah.
I mean, is it even within the thinking?
Yeah, look, some of the lead indicators that you watch on margins, they did come under some pressure earlier this year, but it looks like they're starting to bottom out. So for us, if you get past, don't forget, in the first quarter, even the first 6 months of 2026, you're lapsing a big tightening in financial conditions because of the tariff shock. And that will make year-over-year comps, at least for the first half of this year. And it's difficult to have a lot of visibility beyond that.
Yep.
Because of the midterm elections, that lapsing of year-over-year tightening of financial conditions with easier financial conditions in 2026 means that it's likely to give a lot of support to equities.
Yeah, I think that's probably the case. How about just what screens well for you guys these days? Because it's easy for us to fall back on the AI trade because it's such a big trade.
I know.
And it's worked so well for many investors. But are there other things that are screening well, factor-wise or sector-wise?
Yeah, I think, look, certainly, I think the emerging markets they've been on their back for the better part of the past decade.
Yep.
They've outperformed the U.S. over the course of this year, so has Europe. I think maybe taking some bets on some diversification isn't necessarily a bad thing at this point. You can diversify, out in EM, I think you've got a lot of good strength in terms of an advanced manufacturing push into China. There's green shoots in China at this point. So that isn't a bad place to be. And I think also you can diversify even down into some lower cap size in the U.S. and you'll probably still be able to do well in 26.